By the title, we're going to be covering a very important topic in this live stream, really diving into how credit scores are used as a kind of a synthetic excuse for banks to deny you when it comes to mortgage loans. And this is really going to be a basis around home ownership and why it is still so vitally important financially, economically for us in the current times and for the foreseeable future. So I'm going to be covering a lot in this live stream with an intent to try to do so in a reasonable time frame, but we're still going to cover a lot. We're going to be talking about how credit scores are used as a front for loan denials, how to get around credit score hurdles, why homeownership is still key to financial control and success. I'm going to give you a little bit of background on my experience around home lending, mortgage lending, and banking and finance, as I always do in the majority of my videos. We're going to talk about what the benefits of home ownership are today. What are the barriers to home ownership today? The importance of home ownership being a financial decision and not just an emotional or social decision. What is the current climate to becoming a homeowner today at the time of this live stream? What is needed to qualify, and how many different options are there for home loans? This is going to be very important. How to get an idea of the type of loan that will fit you before you start talking to lenders. So my background is in banking finance, and that includes business banking all the way to home lending and, of course, retirement planning as well. That having been said, a pretty dense portion of that has been in mortgage lending. When I can tell you how important it can be and a difference it can make if you have an understanding of the type of loan that you may qualify for or best fit you going into the process. And it's not that complicated to figure it out. So I'm going to give you some insight on that so you can have a little context going into, your home buying process or that journey. All right. So again, a lot to cover. We're going to get straight to it. So why do I say that banks are using credit scores as an excuse to deny you for home loans? It's not because credit scores are not vitally important to the home lending process. They absolutely are. And I am encouraging every single one of you to take your credit score seriously, build it and protect it. I am not advocating for you to ignore or try to circumvent having a good credit score because it is pivotal to your entire financial journey. All right. That having been said, getting on a property ladder and owning a home and hopefully owning subsequent property outside of that is essential to financial autonomy, financial control, and having agency in your community and overall really in this country as a whole. Being a property owner at one point in time was the only way that you had full engagement as a citizen in the first place. We're talking about voting rights and all kind of other community and civic engagement. So that hasn't necessarily changed that much. Of course, nearly anybody can vote today, and nearly anybody technically can participate on a civic level. But being honest, the people who have the most sway and influence tend to be people who are owners, property owners, business owners. So home ownership is still key, and credit scores are not going to be a very legitimate way to, or it should not be a legitimate excuse, rather, to keep so many people from it. So if you look it up and do the research, or if you just have conversations, you're going to constantly hear that a lot of people are denied for home loans due to credit score issues, right? That is technically true. But what I'm going to break down for you in this live stream and give you more context on is, how many different options that are out there that do not require you to have a crazy high credit score, okay? So we're going to be getting into that shortly. The next thing I want to cover, or the next thing I want to jump on, is my background with mortgage lending and home lending, so you'll have an idea, okay? First off, this is not technically financial advice. I do want to put that out there. At the end of the day, this is kind of informational purposes, educational purposes only. You have to go out and do your own due diligence. You have to go out and do your own research, all of that jazz, okay? But my NMLS number is 771386. Right now, I do hold a state mortgage loan originator's license. It is inactive because I'm under the federal charter of the bank that I work for, and I am not currently originating loans at this time. I am keeping up with my license every year, but it is technically inactive. So I am qualified to present you with this information on the highest level. I am not actively doing mortgages myself. I am more of in a referral loan processor position, as well as the rest of my banking duties. All of that having been said, I have been in direct contact or proximity of mortgage loan originations hundreds of times over the length of my career. So I've either been in the middle of the origination process or right there as loan processing or a referral or direct referral source and gathering docs and data and helping with the qualification process, etc. So I'm not just somebody with the license that went through the book portion and the test portion, but I have actual applicable knowledge and exposure and skills around this, okay? What are the benefits of home ownership? I want to start this part of the conversation off because there's a really, really big narrative that has grown around, home ownership's kind of not all of that. Homes are not an asset. That's kind of a big one that's been floating around from some important bigwig people on the internet, that somehow home ownership is not what it's hyped up to be. That owning a home is not an asset. It's a liability because it's taking money out of your pocket. On paper, technically, you can make those arguments or make those statements and they'd be true to a degree. But there's a broader range of context to look at this, and it's really all about how you go about buying a home. Very important. We're going to get to that in a minute when we start talking about making a home a financial decision and not just an emotional or social decision. So let's talk about some of the benefits of home ownership. So the first thing you're going to get out of it, or the first thing you can consider that most of us are familiar with home ownership, is going to be building equity and wealth. Mortgage payments contribute to building equity, which is the portion of the home that is owned outright. As the market value of the home appreciates, so does the equity. This equity can serve as a significant source of wealth accumulation and providing a financial safety net for the future. So just in case, to not take for granted that everybody that's going to catch this understands the value of equity or what equity is, essentially it's going to be the spread from the value of the home versus the debt on the home. A mortgage is debt. You're basically taking money from a bank or qualifying for money from the bank to purchase the home. You're putting it usually in conjunction with your own money to take down the purchase price of that home. That home might be valued at $300,000 in the marketplace. You may have taken a loan out for $280,000 and put $20,000 down or something along those lines, right? $20,000 in cash down, $280,000 from the bank to take down that $300,000 property. The equity is going to be the $20,000 you put in, and then as you make mortgage payments, you're going to accumulate a little bit of equity at a time, as well as the property is going to naturally appreciate in a given market, which real estate typically does most of the time. Shout out to everybody coming in on the live stream that is liking and sending hearts and emojis. I appreciate y'all for coming in. Thank y'all. So that's where your equity comes from. It comes from mortgage pay down and the value of the property growing over time. There's a lot of moving parts that contribute to the value of a property on an economic level, like on a national level, right down to that local neighborhood that you're in. There's a whole lot of moving parts to the value of that property growing. Generally speaking, real estate appreciates over time, generally, okay? Next component is tax benefits. Homeowners may be eligible for tax deductions on mortgage interest and property taxes, potentially reducing their overall tax liability. Additionally, when selling a home, a portion of the capital gains may be excluded from taxable income, provided certain criteria are met. So what that basically means is you're generally able to write off the mortgage interest on your payments. You're generally able to potentially write off the taxes that you're paying, the property taxes that you're paying off. And you also may have the opportunity to sell that property one day at a profit and not have to pay capital gains taxes on it. So capital gains is going to be, I own the property, 10 years, and I only owe 200 on it. It's still worth 300. It's grown to 350 in value. Okay. Your 200 you owe versus the 350 in value is $150,000. When you go to sell that property, if you sell it for the 350, you're netting hopefully somewhere around that 150. You're going to have other fees that'll come out of that most likely, but let's just run with it for even numbers. You're coming out with $150,000 in profit, which was the original equity, turns to profit because you sold the home. That's considered capital gains in the eyes of the IRS. You generally have a certain threshold where you're able to not have to pay taxes as an individual, and a certain threshold when you're married and sell the property, okay? Generally, it's like $250,000 for an individual, $500,000 for a married couple. Depending on when you catch this video, do your own research and due diligence on those specific numbers, but that's how that works. So this is something as a tenant you don't get the benefit of, right? You don't get to just sell the property you're in and, or write off some of your rent for taxes, right? You pay your rent, you get no tax benefits for that. When you pay your mortgage, you have tax deductions for that. You sell the property for a profit, there's tax benefits for that. So these are just some immediate value points of home ownership. Stable housing costs. This one is a little up in the air in today's market, but we'll get to that in a second. Another benefit of home ownership: fixed rate mortgages provide predictable monthly principal and interest payments, shielding homeowners from fluctuations of rental costs. This stability aids in better financial planning and budgeting. That is 100% correct. Minus escrow, taxes, and insurance. I live in Southeast Louisiana, and I am in one of those parts of the country where their mortgage payments are anything but stable for a lot of people. Basically, insurance costs and tax costs are going up significantly and drastically impacting overall mortgage payments. So unfortunately, this one isn't as, fixed depending on where you are in the country, because if you're having a lot of natural disasters or other challenges that is putting pressure on insurance companies, the premiums for insurance on your home go up. Also, if you have valuations and properties growing really fast, taxes can end up going up because taxes are based on the value of the home. So these, stable housing costs is kind of iffy. All right. What do we have next? Protects against inflation. This is an important one. As a renter, you don't get the benefit of, generally speaking. You're actually on the wrong end of it as a renter, as a tenant. Protection against inflation. Real estate can act as a hedge against inflation as property values and rental prices tend to rise with the cost of living. Locking in a fixed rate mortgage can help a homeowner stabilize housing costs in the long run. This one is true. This is basically meaning that the type of mortgage loan you get is important. If you get what's considered a fixed rate loan, meaning that the rate that you get is locked in for the duration of the loan, then basically you don't have to worry about the rate of the mortgage fluctuating on you and potentially going up as the market changes or as inflation goes up. There's a little correlation between mortgage rates and inflation, okay? When inflation tends to go up, mortgage rates can go with it. And when inflation's down or coming down, mortgage rates tend to come down. So a fixed rate basically means that your debt stays fixed, and inflation is always baked into our economy. For those of you who may catch this that aren't as familiar, inflation is the rising cost of goods and services, or some economists may say the falling value of the currency purchasing those goods and services. You do your due diligence on how you want to interpret that. But either the money is getting less valuable or items are getting more expensive. Take your pick. Either way, the effect is the same, okay? So that's inflation. Your home cost can stay the same. And typically your value, when inflation goes up, the value of your home usually might go up with it. That tends to be how that can go. There's other factors that play, but basically your housing cost, the principal and interest can stay fixed. So that's really up to the loan that you get. All right, next, personal and community benefits. Personalization and control of the home. You have the ability to do a lot more of what you want with the home and make it your own versus when you're renting. Sense of stability and security, because you typically own the home or you're the one controlling it as you pay on it. You tend to have a lot more stability than if you're renting, and a lot of things can change. The landlord is the one determining your stability in that home. If something happens to them, if they decide to sell a property, they want to do something different with the property, all of that can happen in days' notice and you have to move around. With home ownership, as long as you're paying on time, it's yours. And even if you're not paying on time, you may have months, potentially even a couple to a few years before you have to actually get out of that house. So a lot of stability in that component. Community engagement and social connections. I kind of brought this up a little bit earlier in the live stream. You're basically looking at a scenario where, you have usually going to have other homeowners in that area where you're living. You guys have a shared interest in hopefully keeping up with your property, your neighborhood, and stabilizing and hopefully growing your home values. You're hopefully going to share other values because you're likely going to the same grocery stores. Your kids are going to the same schools. So there's a lot of community value there. Social connections come from that. Civic involvement is one they didn't talk about, but I'm going to throw in there because when you own property, you have so much more of a voice when it comes to local political issues and local social issues, environmental issues. When you own, you have a lot more of a voice than when you're a tenant. That's a different story. So that is important for you to keep in mind. A lot of us are trying to get socially engaged and politically engaged, and we don't own anything. Thank y'all for liking when y'all come in. I appreciate every single one of y'all. We're not engaging we're not able to engage on a healthy or an impactful level when we don't own anything. That's just how this works. It's just being honest. So you being a homeowner, especially if you own multiple properties, if you're like an investor in the area and you're like local, or if you just at least own your home, you have a really respectable voice on social and political and environmental issues. So I'm gonna throw that one in there. Pride of ownership. Owning a home is often seen as a significant life achievement, boosting self-esteem, providing a sense of pride and accomplishment. That's the social component. That is true. I'm going to also throw in the fact that if you have kids, there are a lot of statistics and studies showing that owning a home has a very positive benefit in that stability and that community feel for children. So that one isn't in here. That one is something, if you happen to be a parent, a grandparent, or a guardian of some type, or plan to be, that is another component of home ownership that may not be there if you're more transient as a renter. All right. So let's dive into what are the barriers of home ownership. This is a big one. What is stopping more of us from owning homes, right? Home ownership is on a decline in America as a whole across all ethnic and racial groups, generally speaking. I don't want to say that as broadly. Let me back up. As a nation, regardless of like breaking it down by race, home ownership is down, right? That having been said, there's certain groups that obviously are way up in the ladder on home ownership, and there's those of us that are way down, okay? Overall, though, a lot of the issues that are plaguing any group of people in this country, as Americans as a whole, is usually about the same, okay? So generic, we'll call it generalized or generic issues with qualifying for a home or common barriers, all right? Affordability, and that breaks out into a few different categories we're going to get into, all right? And then, of course, as I go through this, I'm going to give you guys solutions to this. So stick through with this and pay attention, maybe even take notes. Affordability, this is consistently cited as the biggest obstacles by aspiring homeowners. So what does that break down to? High home prices, insufficient income, down payment and closing costs, saving up enough for down payment and closing costs, increased debt burden. So meaning having higher levels of student loan debt, auto debt, credit card debt, and affecting your debt to income ratio, making it harder to qualify for a mortgage. So all of that falls into affordability, okay? If you look into a mortgage calculator, those of you that like to play around on Redfin or Zillow, there's a mortgage calculator and affordability calculator specifically. This is going to give you some of the major metrics that affect your ability to afford a home and allow you to punch in your particular numbers and give you an idea of how much home you can qualify for. Everything I just named contributes to that. So higher home prices, insufficient income, down payment and closing cost assistance, and overall DTI or debt to income ratio or overall debt burden. That's number one obstacle for barriers. Number two is going to be high mortgage rates. Currently, the environment we're in, we're about 2 decades, like over the last couple decades, 2 decades to 25 years or so, we're at the highest mortgage rates and overall interest rates we've been at in quite some time. So basically back to early 2000s, right? So high mortgage rates really impact qualifications and can be a barrier. Low inventory is another one. This is another one we'll talk about in a minute. Difficulty qualifying for a mortgage overall. So general mortgage standards. There's a lot of different moving parts to qualifying for a mortgage. So just the process in itself and how it's changed since 2008. These are some of the 4 biggest sets of barriers that many of us are facing, okay? So as far as the low inventory portion, we are at historically low inventory in this country in most markets in the United States. Generally speaking, there is a serious gap in home affordability, affordable housing in the United States, okay? So entry-level homes and, the next tier up over entry-level homes, so what might be many people's second home, that level of inventory is extremely low relative to the amount of us that are trying to buy them, okay? That means that is pushing up the price of homes, for one, generally, because you have a supply-demand issue. But it also creates a scenario where, essentially there's just less inventory for us to acquire and get our hands on. Thank y'all for liking the video, the live stream. As y'all come in, I appreciate y'all. So that is the generic version of what is stopping people. All right. If you happen to be specifically to the Black community, because those of us in the Black community, we're the lowest on the totem pole for home ownership. We're in the 40% range, 40 something percent, meaning that less than 50% of us own homes as families or individuals. Okay. And so other groups in the country are doing better at that and having greater success. So what are the unique challenges for us in Black America? Generational wealth gap is going to be one of the biggest reasons. That breaks out into a few different things. All right. Historic discrimination, got to acknowledge it. Income inequality, got to acknowledge it. Limited access to credit and banking, huge. Student loan debt, big one. All right. Housing affordability and access, housing shortage, high housing costs, appraisal bias does happen, housing market discrimination, and limited housing choice vouchers. So basically where Section 8 has a program for home buying. A lot of people, even myself, actually, I didn't really know that until recent years. But there are, Section 8 is not just about tenants. It's also programs for home ownership, and it does have a limited in capacity. And that has also been one of the attributes that has particularly impacted Black America. Lack of support and resources, right? So limited access to financial education and counseling, huge. Fewer generational transfers of wealth, huge. So this one's going to be, a lot of people, and I see this firsthand for, in my career on a day-to-day basis, a lot of people who have been able to accomplish home ownership, especially in the difficult climate we're in today, have had the benefit of gifts and inheritance contributing to that. So we have to acknowledge that one. Lack of Black-owned financial institutions. I did one of the biggest live streams on my channel about 2 weeks ago on the importance of Black banks and how they are nearly extinct, and how not having them is disproportionately impacting our ability to develop wealth in this country. We're underbanked. We can't access capital. We can't manage our money. We're paying exorbitant fees for financial services, and we can't access the capital we need for stuff like business ownership and home ownership. So they're citing that when you search it, literally the lack of Black-owned financial institutions, limited access to capital for Black banks, and financial institutions targeting underserved neighborhoods restricts lending and economic development in communities of color. There is no doubting that there is a huge issue around not having enough Black institutions to cater to the needs of Black America and disadvantage Black America. That does not mean that we don't want to, there's an issue integrating and working with mainstream financial institutions and non-Black financial institutions. I teach all day on this channel how to build relationships with any bank in the country or credit union. I'm all about that. But we have to acknowledge that every single financial institution, especially for profit, are catering to a certain demographic of people. And so when it's not you, then they're going to have requirements and criteria that are more difficult for you, because they're built around the niche that they're looking to serve. And it's not that they're going to have like white only banks and all of that in today's modern world. What I'm saying is they're going to be based on their demographics, and there's still very concentrated demographics all over the country. You have predominantly white areas, Hispanic areas, Asian areas, Black areas, etc. You have, you still have relatively homogenous economic ecosystems, basically. So that means you have specific economic circumstances around Black Americans and white Americans and Jewish Americans, etc. So it tends to be natural that you're going to have, wherever those problems persist for that said subcultural group, you're going to turn around and have solutions provided specifically for that group. When you don't have Black banks and enough abundance in Black communities around the country, that forces a lot of Black Americans to try to either force integrate into non-Black focused institutions, which is a lot harder, or a lot of Black Americans just give up and use very expensive and low convenience financial resources and services and forms of credit. So it just gets messy. So I'm really big about the Black-owned institution when I'm huge about that. So that's another barrier to entry specifically for Black Americans. All right. So we know what's plaguing the country as a whole. Now we have an idea what's plaguing Black America around home ownership, which we know is one of the key ingredients to financial success and stability in our financial system. So we know the value or the benefits of home ownership. I see y'all dropping some comments down there. I'm going to get to those in a minute. what are we know the benefits, we know the barriers. All right. What is the importance of homeownership being a financial decision and not just an emotional or social decision? Keep in mind, those of you who are sticking out the live stream, I'm going to get into criteria, qualifications, down payment assistance, programs, loan types. We're going to get into all of that in a few. Hang with me. I'm giving context. This is a live stream. This is intended to elaborate a little bit. So I want y'all to hang tough. If you're watching the replay and you're catching it this far, stay focused. We're going to get to some of the juicier details that some of you may be focused on. You want to get into, all right? So when we talk about the decision-making of owning a home, all right, hold on for a second. All right, I just wanted to pull up a quick list that we're going to go over in a second. So anyway, when we start talking about the financial decision of owning a home, this is essential to making home ownership work. I need y'all to pay very close attention to this portion. Home ownership has to make financial sense. You will see a lot of content. You will see a lot of conversation and social posts picking at the idea of home ownership actually being a smart financial move. And the reason for that is many of us don't make home ownership a financial decision. It is an emotional and social decision. It's a lot more about the pride. It's a lot more about proving something to other people or having that as a talking point or a badge of honor in front of other people. It's a lot more about, oh, I just want to have this big old space. I want to live in this certain neighborhood. It's a social image. It's a flex. It's a lot of different things other than actual financial decision. This is where home ownership goes wrong. This is where you start seeing people come out with videos where they're crying and they regret it. It was a bad decision. It's costing me more than it's worth. This is where it goes wrong. What does making home ownership a financial decision look like, right? What it looks like is, how do I buy this property with either the current and or long-term viability of it becoming an actual asset for me? So dig a little deeper. Let's get a little on a granular level and break that down further. How do I buy this property, for instance, maybe distressed? Like I bought my home. My first home I bought was under a short sale and it was newly renovated. But in the process of the new renovation, trying to sell it, at the top of the market, the person fell behind on their payments and got to the point where they got all the way to a short sale. So I was able to buy a newly renovated house at a discount. I walked in with equity. That is one way you can do it. Buying a distressed property as a primary residence. That is a smart move. Again, we are doing this to create financial autonomy. We are using this to create financial success, stability, control. So we need to make this a smart financial decision, and then it can come with some of those other benefits, those intangibles, right? So buying it distressed is one way to make home ownership a financial decision. Can I buy it on a short sale? Buy it pre-foreclosed or foreclosed? Can I buy it, whatever the case, it needs a lot of work. Whatever the case may be, is there a way I can either walk into equity and value or walk into a scenario where I can create value? So we'll talk a little bit more about that with various loan products when we get to that back end of that, all right? So stick around. But that's one aspect. Can I buy this property under certain circumstances that will create immediate equity or value for me? That's number one. Number two, can I buy this property as a multifamily or at least with some kind of additional dwelling unit or accessory unit? A detached garage, a mother-in-law suite, a really nicely designed or flexible shed sometimes works. Can I find a piece of this property? Sometimes people have the type of attics that they can turn into living space. The attic has got a tall roof. It's got a bunch of square footage. There's a certain level, type of flooring you can lay down, and you can make a whole living space out of an attic. I've seen somebody literally add a ton of value to their regular single family home just because the roof was so tall from the base of the attic. They were able to create an entire 1,000 square foot living space on top of the home without having to really add square footage in a structural sense, which was crazy. added a ton of equity and added additional living space, not only from their family at the time, but if it becomes a rental one day, you just created that much more space and you didn't even have to add to the structure. So that's just an example. Can I buy a 2 to 4 unit or an additional dwelling space, an additional accessories unit, ADU, if you want to call it that, or renovate it in a way that, like I just broke down with the attic space situation, that creates additional living space? Why? Because I want to be able to make money either while I'm there or when I'm on my way out of the property and I want to be able to keep it and rent it out. A lot of people's first rental is the first property they own. They keep it and rent it out, which is smart. This is why another reason, financial decision. The next one, when you buy it, can it make a good rental later? So that means, am I in the HOA and they're not going to allow me to rent it out? Is it in an area where it's attractive, like the subdivision is nice or the neighborhood is nice? Is it too high class to rent it out? You know what I mean? Is it one of those areas where it's a little bit too high class, A class of a neighborhood to rent it out? Like the neighborhood won't support it, or it won't draw in a rent that makes sense, like a tenant that makes sense, right? What are the schools like? What are the proximity to the interstate and travel? What is the proximity to the things that people need on a daily basis? So when you're buying a home, you want to think about the future potential of that home. Yeah, you're going to be there for whatever window of time, but most of us move within 7 to 10 years. Like after our first couple of homes, we're in and out of between 7 and 10 years. Most of us aren't in our first home forever. That's not common, especially in today's world. It's just not that common. So how do I turn this into an asset later? If it's not immediately one, can I turn it into one later? So when I buy, can I buy it either distressed in some form of fashion or with value add potential, meaning it needs renovation? Can I buy it, with multiple units in it already, 2 to 4 units naturally? Or the zoning allows me to turn it into a multifamily or use an attached or detached part of the property to turn it into another unit. Can I buy it in a way where it's going to have rental potential immediately? That's number 2. Can I buy it and have rental potential later? Okay, it's just a regular single family, but when I leave, can I turn this into a rental property for myself? Is it in the right neighborhood? Is there an HOA that's going to be a problem? Is it too upper class? Is it too low down? Is it too lower class and too bad of an area? Is it poor and is it too far out? Are the schools horrible? What is the viable option to turn into an asset later? So those are 3 major ways to look at it. When I'm going to buy a home, can I purchase it with the financial prudence in mind, the financial investor in me in mind, the part of me that's looking to create financial legacy? Can I buy my home with that in mind? Too many of us suck at that. We buy homes for all the wrong reasons and it ends up kicking us in the behind. And this is why you have the Andrew Tates, the Grant Cardones, and some of these other more prominent figures down in home ownership for most people, because most of us are too busy trying to be cute, or we're too busy trying to prove something, or we're maybe just looking at it from the family stability and good school system part or whatever. We're looking at it from so many different angles, but as a financial resource or a potential future financial asset. Is the neighborhood and the zip code I'm in, has it been growing in value? Does it have future potential? Or is it a scenario where it's one of those areas that's extremely dependent on like one employer or one industry that can go away at any point and completely sink the value of this area? You have to look at it like an investor. And so that is one of the most important components that's going to make homeownership an actual economic and financial benefit for you, is how do I make it an asset? How do I, go into this and looking at it with an investor hat, then a parent hat, then a, flex from our family, friends, social group hat, all these other reasons and benefits that, we just talked about. So that's important. That section is very, very important. Again, I'm putting all this on the front end because it is very important before we just start diving in how to qualify and how to get around some of the obstacles and barriers. You need to understand how to make financial sense and why you're going through all this in the first place. Owning a home and qualifying for a home is not easy. It is difficult. There is pride of ownership because the barrier to entry is not easy. So why are we doing all of this? Home ownership has a lot of benefits. Many of them need to be financial and economic. The rest of it is great value add, but you want to make sure that you're making it make sense for your financial legacy. So we hopefully that makes sense. Comment down below if you have questions about what I covered around making home ownership a financial decision and not just an emotional decision, okay? What is the current climate to becoming a homeowner? This is a big one too. I'm gonna try not to over talk on this one, but this is a big one. What do we have here? We also really need, hold on, did you say? Yeah, all right, cool. So, truer than you know, that student loan debt is crippling. I seriously underestimated the impact of my private student loans on on the quality of my life. It's costing me nearly $1,000 a month. That is crazy. That is crazy. I am sorry to hear that for sure, but I respect that. We also really need financial literacy. I'm going to be doing a live stream on that one very soon. Truer than you know, that is exactly what we need. I am putting things together in my 40s that I should have focused on as a teenager. Tell me about it. We all doing that. Trust me, we all on that path. Even with me being a financial professional, there's a lot of things I'm doing now I wish I would have did 10 and 15 years ago. Today, finance bros are saying that you should buy a house to make memories, not money. Is that a fair assessment? Absolutely. TF not. I'm gonna be respectful and not cuss on here, but absolutely not. That is not it. Finance bros are getting on that wave though, truer than you know. It's 100% facts that there are a lot of financial gurus, content creators, and that are getting away from home ownership as a financial move and trying to make it something like, oh, don't, you know, some of the content creators I respect are saying that, right? Like a good example is going to be Minority Mindset. I respect him a lot. Jasprit Singh, he does really good work in personal finance. And he's one of those people that has been saying for years, you know, don't buy a home, you know, with it in your mind as an asset. You know, buy the home for your memories, for your family and stability, but it's not an asset. I understand where he's coming from, but I am absolutely pushing back against that. I am absolutely pushing back against that because one of the biggest instruments of financial legacy that is passed down is paid off property. Literally, that is one of the biggest things. You got life insurance, you might have other retirement assets, but generally speaking, one of the biggest, most common financial assets passed down. Number one, in retirement, before you even pass away and pass it on to heirs, home ownership and paid off property is one of the single biggest assets most Americans in the working class and the middle class have when they retire. So you can't sit up here and try to tell me that a home isn't an asset or doesn't have the capacity to be an asset. Millions and millions of people retire and are able to retire because their house is paid off and they don't have that payment, and they also have that equity as something they can reach if need be. That helps support their retirement. Next is the legacy portion. The majority of the most common financial asset passed down when people pass away, one of which, if not the biggest, is homes, property. So by no means, my friend, truer than you know the answer. Absolutely deep or not. Absolutely not. It is not. I am not agreeing with that at all. And I will stand in front of any of these prominent, well-off finance creators, including the ones I respect and appreciate. I don't give a damn what they say. That is not correct. And if you are not well off in some other capacity, meaning you have extremely high income, you're a great stock investor or something else, like a great business owner, then you absolutely need to be making a home ownership one of your biggest pillars, because you don't have any of these other things that people are leaning on and telling you to get into as an asset yet. Home ownership is a very difficult financial accomplishment, but it's also one of the most common and the most understandable. So you can accomplish this earlier on in your journey. And before you get into something complex like trying to be a successful business owner, that has way more hoops to jump through and bells and whistles, okay? It is also the premier way to build wealth in this country, but it is hella hard. Home ownership is difficult, but it is a lot more autopilot to it, you know, in building financial success through home ownership. And what I'm giving you in this live stream gives you the tools and the mindset to go into it and making it an asset. It is totally doable. We're going to get into that on the back end. And I know this live stream is kind of running long, so I'm going to kind of, skip to that. We're almost there. But I promise you, no, I am not in agreement with that. Home ownership is a very key factor for the working and middle class in this country, and lower working class and low working class and lower end of the country. If you are looking to try to build and create some kind of financial legacy, real estate is still one of the prime ways to do it, and not just rental real estate. We're talking actual primary home ownership. And if you do it right, if you have the right mindset and go into it right, you can absolutely turn your primary residence into a financial legacy tool and a retirement tool, and maybe even an asset now if you listen to what I'm telling you. All right. I hear on home ownership, it's an investment when you purchase strategically. Thanks. Yes, that is one of the biggest components is purchasing. That is really, you're making your money when you buy. You're not making it when you sell. You're making it when you buy. Okay. So absolutely home ownership works. I love when my finance bros are listening to each other critically instead of blindly. Yes, absolutely. I listen to several prominent finance creators that I really like and respect for years, even though I've been doing this for years. And some of them I like. I've been doing financial services and banking and lending longer than they have. Like, they haven't been in finance. They're more recent. I've been doing this back since 2011. So really a little bit longer than that, but like really prominently since 2011. I haven't been on the internet that long, but I've been doing banking and financial services and lending that long. So I have people I'm watching that have just got into this in the last 5-7 years that I still respect and tip my hat to, and learn from, and etc. So anyway, yes, absolutely. Great comments, great feedback. What is the current climate to becoming a homeowner? This is big right now because we're in extremely strange times economically, period. And when you're looking at home ownership and real estate, it's unique. So a few highlights around this, to not spend a ton of time, but to give you some context on some of the challenges and potential opportunities of the current environment we're in becoming a homeowner, okay? Mortgage rates are high as hell. Home prices are high as hell. The interest rate environment from the national level is been on a roller coaster since COVID, the last 5 years or so now, meaning that is affecting the overall economic system, job stability. Inflation has been on a tear and been terrorizing us for about 3 to 4 years now. So we're in very strange times. All of these different levers and mechanisms I just talked about, inflation, overall interest rates, mortgage rates, home affordability, because houses are more expensive now. Job stability is being threatened right now because of the economic circumstances. The political environment is kind of crazy and affecting things. There's a lot of moving mechanisms that are affecting your ability to get into a home, because all of those different metrics I just named affect your personal finances, your job stability, the taxes that you're paying, and the amount of money you're taking home or you're paying in taxes. The interest rates are affecting your affordability. You have, things that same mechanism are going to affect your credit, because if you have job loss, that can obviously trickle out to your credit. The cost of the debt that you already have, like student loans or credit cards, if that debt is rising, then that's affecting your DTI. So you see how these mechanisms way up in the food chain on a macroeconomic level come down and affect your personal finances. The Federal Reserve might move rates up trying to stop fight inflation, but then they made your student loans more expensive, your credit cards more expensive. So that debt is growing. So on your credit report, your debt is inflating, and that's overall impacting what's called your debt to income ratios. Your debt's rising, your income staying the same because you're not getting big pay raises at work because of the economic environment you're in or the industry you're in. So your debt is going up, your income staying flat or going up too small. Your debt to income's going up. That's affecting affordability. I hope that all connected for you just now. There's a lot of different large macro level levers affecting your personal finances on a day-to-day basis. So the economic environment we're in right now is home ownership is hard as hell if you're not already on the property ladder. If you're on it, it's still hard as hell, because you may be in a scenario where you have a really low interest rate, and selling it may force you to have to take on double the interest rate. So like your cost of home ownership doubles, right? Like, so you locked into the mortgage that you have right now. It depends on where you are. But for a lot of people, it's either hard to get on the property ladder right now or move around on the property ladder because of a myriad of economic and financial factors, okay? The barriers are plentiful. The benefits or the opportunities that are there right now. There are markets like where I'm at in Southeast Louisiana where that the rising interest rates have wreaked havoc on the housing market, and you are seeing price drops. Nationally, homes are still growing, generally speaking, which is crazy because there's a ton of downward pressure on homes through higher interest rates and other factors. That having been said, that just shows you how much pressure is in the system when it comes to inflation and home values, because home valuations are still overall on a national level growing, even with a lot of downward pressure. So it's hard as hell to get into a home right now, but we're in an environment and a cycle, an economic cycle, where strategically bought homes could see a great upswing in value in the next coming years. The main reason for that is because the financial system cannot hold on to higher interest rates for much longer. We still have a serious inventory crisis, which creates supply and demand issues, meaning that those who do own homes and own property will naturally continue. This is one of the reasons why property values are still going up, regardless of the downward pressure of interest rates, because you still have a massive shortage of homes to the tune of a few million, many notable sources say. So that basically means that even though it's harder to qualify for a home, enough people can still qualify for it to create a supply and demand issue. So that's not going to get fixed soon. We have anywhere from, I've seen number from 2 to 4 or more million home shortage in the United States. The market I'm in Metro New Orleans alone, has around a 45,000, New Orleans proper actually, I believe, has around a 45,000 affordable home shortage. New Orleans is a small city. It's a small, big city. And I'm giving you that example to show that just in New Orleans alone, there's a 45,000 affordable home housing shortage. That number is much larger in other major cities. So you have an inventory shortage that won't fix itself in the next few years, okay? Because you can't build that fast. And there's a lot of restrictions and issues around building at scale right now that are still in play, okay? So that problem isn't going to fix itself quickly. That's making buying property right now as a homeowner in most of reasonable areas. You can't just buy a property anywhere and this is going to work. You have to buy strategically, as I keep saying. But you can see upward mobility happening even with interest rates up right now. So number one is inventory issues. Number two is going to be interest rates will have to come down at some point. I've been on record to be wrong on the timing. I said sometime last year this should have came down. They didn't come. They did get knocked down a couple times right around election season, and they stopped. They dropped it a couple times and then they stopped. I was calling for it earlier to mid last year. I was off. I'm done giving my predictions on that because the economic system and political system is insane right now when it comes to that. It's too hard to tell. But I can tell you, just understanding economics in this country, the interest rates absolutely have to come down at some point. The Federal Reserve controls interest rates. I've done videos on this, and they have a few mandates, but they have more commonly 2 mandates: price stability and maximum employment. They're doing their best to keep the price of goods and services in a healthy ratio, keeping inflation to a balanced level, not cutting it all, but keeping it to a balanced level and making sure that employment is healthy and high in this country. Those two can conflict with each other because the cost of goods and services can go up and the interest rates have to go up to bring those costs and goods and services or slow them down from growing. Hopefully that made sense. They have to make the cost of money more expensive in order to bring down the price of goods and services, or at least to stop it from growing as fast. Doing that naturally slows down the economy and slows down employment and even leads to higher unemployment. I'm not going to get into the weeds. I've done videos on that, but all of that basically means the Federal Reserve is the one controlling that, and they are under a lot of pressure to lower interest rates. The banking system, the overall economic system, the stock market, Wall Street, and a lot of other important entities need interest rates to come down for the health of the economy to grow. That basically means that when rates come down, that means inflation has been down, mortgage rates likely will come down when rates come down as well. Likely. They're not directly correlated, but there's a strong correlation. What that means is when mortgage rates come down, you and I can afford more home. Okay? You and I can afford more home because rates are lower, making our borrowing costs lower and our financing costs lower. That means that that's more money can be going to that our income goes further because we're not paying as much for the debt now. More of that is going towards qualifying for the home. If you're coming into the live stream by chance, make sure you like, leave comments, leave some kind of signal that you're in. Show some love to the video. A lot of good information in this one. So, cool. That's the current environment. All right. There's two major reasons. Inventory issues, interest rates eventually coming down, amongst many other things. The transaction level of real estate in the country is slow to a grinding halt. It is down significantly. That affects overall economic activity. So I promise you, there will be a lot of resources pouring into helping people buy more homes. Politically, economically, it has to happen. So if you own a home, especially if you can get in now while everything is all discombobulated, you are improving your chances of riding the wave up on the price of homes and the value of homes in the future. So that is our glimpse into our current economic value. Now to the juicier part that some of you, hopefully who have stuck this through, may be interested in. The various qualification metrics and the various different loan types and what's out there for you to qualify for a home, okay? This is gonna be us rounding out and closing this out. So, what is needed to qualify for a home? That's the first question I have down here. The first thing is going to be income, credit, debt to income ratio, and that's your big ones. The rest of it is going to be around the property and things like that. For you, your credit, your income, and your debt to income ratio are going to be the biggest factors you directly are going to be responsible for and can control. Let's get into that in a little bit of depth, okay? Your income, it needs to be high enough to qualify for whatever you're trying to get in the home. It needs to be stable. You need to have had it for a while, generally speaking, around 2 years. It needs to be a consistent work history, ideally. There's other options if not, but it needs to be a consistent work history, generally 2 years. Now, what does that break down to? That breaks down to the type of income you have, the industry you're working in. Type of income, W-2 versus self-employed versus business owner, all makes a difference. W-2 is the most favorite form of income by the banking and lending system. It's the cleanest, simplest, and favorite form for underwriting. You need to have that for 2 years. You can switch around W-2 incomes, meaning you can go from a different job to a different job, but you need to stay in the same type for 2 years. If you go W-2 to 1099, you have a problem. You're resetting your clock because you're going to need 1099 for 2 years, generally speaking. There are alternative loan products out there for this problem, but we'll get into that in a minute, but it will cost more money for you. Okay, so sticking to the same job or at least the same industry for 2 years, same income type for 2 years, very important, okay? If you're going to do W-2, great. If you're going to do 1099, you definitely need stability there. Do your tax returns properly if you're 1099. Do not write everything off. You want to be able to qualify to borrow. So many of you are writing everything off to earn or to keep or to get back pennies and costing yourself a lot of dollars. What do I mean by that? When you write off for tax returns, most of y'all are getting a 3 or 4 figures on tax returns. You're writing everything off to not have to pay and owe and to try to get a return back. Most of you, if you're lucky, you're getting 3 or 4 figures. So maybe you're lucky, you're getting $2, $3, $4, $5, $6, $7, $8, $9,000. Maybe some of you are doing really well. You're getting $10,000 back in taxes on tax returns. That sounds nice. It feels great until you do the math and find out that you're costing yourself tens to some cases hundreds of thousands of dollars in purchasing power. You're shooting yourself in the foot and blowing the whole foot off. You're not just knocking off a toe, you're knocking the whole foot off. So it is important for you to understand when you are looking, when you're on a 1099 or some kind of business owner income, you have to do your taxes diligently. Don't write everything off. Show as much income as you can and pay Uncle Sam. Pay that man his money. Why? Because you might have to write him a 3 or 4 figure check. It sucks, but you're going to turn around and qualify yourself for 10 to potentially 6 figures in borrowing capacity. That's right. If you write everything off and you gross $80,000 a year, but then you wrote everything off and it looks like you only made 30, you're going to be, that $50,000 you wrote off can cost you hundreds of thousands of dollars of home you could have bought, 100, 150,000 or more in home you could have bought. Huge difference. If you gross 80 and then, be diligent about how you do your taxes and you show that whole 80, or you can show upper 60, 70 something thousand of that 80, you're putting yourself way closer to your maximum borrowing capacity. This is what you want. You don't want a few pennies or a couple hundred or a few $1,000s in tax returns every year, but you don't own anything. You don't own any property. You can't qualify for it because you're writing everything off on your taxes being small-minded. So if you're getting a unique income outside of W-2, be very diligent on how you write off it. That includes W-2, but many times that's different. Whatever your income source, be diligent about your taxes, all right? So that's income. Credit. Credit affects barrier to entry and pricing. Credit is going to be, what do I mean by barrier to entry? You have to have at least a certain level of credit score to qualify for a loan at all. If your credit score is non-existent or abysmal, like really that low, then you can't qualify for a loan at all because you're beyond the risk level that any lender is willing to take. Your credit score determines risk and it's going to determine the pricing of the loan that you're taking on. So the risk is going to determine your pricing. If you're extremely risky, you're gonna pay a lot more to get access to the money that's being lent to you. If you are low risk, if you're responsible, if you look clean, you have a good track record, you're lower risk, you're going to pay a lot less for the money that's lent to you because the lenders are a lot more confident you're going to pay them back. They're going to charge you a hell of a lot more if you're high risk because they're not sure they're going to get their money back. So they're going to fight like hell if they do approve you to get as much of that money up front as they possibly can. Hopefully that is a simple way to break down good credit versus bad credit. All right. Credit score is an excuse by banks to deny you for home loans. What this means is you can have relatively rough credit. Think 500 and up. All right. If you're below 500, you are probably out of the picture. But if you're in the 500 to 580, low sixes, there are options out there for you. And it is important for you to consider this because there are way more expensive options, of course, because you're higher risk, but it puts you on a property ladder if you pursue it. And you can always build your credit and finances up a year, 2 years later. You're already on the property ladder, getting some of the benefits of home ownership that we went over, financial and non-financial. And you can always refinance to a low-cost loan and benefits later. So the goal is to get the benefits of owning a home as soon as possible. So if you are in that 500, 520, 550, 580, 600, 610, 620, you're in that lower threshold, there are loan options out there for you. We need to discuss that because you need to be, if you have other metrics going for yourself, like good income, good cash reserves, good assets, whatever, there's options and you can get on this property ladder and benefit yourself in the short term now and then work on course correct for the credit part later. Okay. So the next is DTI, debt to income ratio, is a big one. This is a matter of whatever I earn and whatever I present in income versus my debt load reporting on my credit report. So your grocery bill, most of your utility bills, all of that stuff is not what they're thinking about when they're talking about your debt. They're talking about money you actually owe creditors and lenders, student loan debt, other personal loans, auto loans, credit cards, other mortgages, and a lot of you nowadays are playing with consumer financing, meaning that you owe these buy now, pay laters, and they're starting to report. Any of that's reported on your credit report, that's your debt versus your income. That is your DTI, your debt to income ratio. That is a huge factor towards qualifying for a mortgage because every single mortgage is squeezing into some kind of guideline where it only wants to be a percentage of your income. So it may be all debts have to be less than 50% of your income, or all debts have to be less than 36% of your income. Depends on the loan product. What that means is auto loan, student loans, mortgage, all of that stuff needs to be 36% of your income, 44% or 42% of your income, 50% or less of your income. It has to all package up. You have to still have income left over after, is what that basically means. So debt to income is enormous and very important. And a lot of people take it for granted. But trust me when I tell you that managing your budget basically is going to be essential to qualifying for a home. So next, what are the various loan products that are available to you to qualify. So we're going to break this down into two buckets: qualified mortgages and non-qualified mortgages. Think about government-backed or government guideline loans, and then think about private market loan, ones that the government's not backing and not doing their guidelines for. So this means private lenders and institutions that are coming up with their own products and their own guidelines, largely outside of the parameters and criteria of the government. That's our two buckets. So, for those of you who may be familiar, think your FHAs, some of your conventional loans, Fannie and Freddie, you may have heard of, those government agencies that are controlling the guidelines for qualified loans. That is going to be the ones that most traditional brick and mortar banks and a lot of your mainstream financial online lenders are going to offer you. They're going to offer you loans that will fall in the bucket of Fannie and Freddie, qualified loans, or potentially backed loans. So FHA, conventional, VA, USDA, all of those are qualified variations of qualified mortgages. So run through those options really quickly. FHA is going to be one of those options that you can turn to that will provide you with low down payment requirements. It will accept lower credit scores. It will, it will be one of the easiest barrier to entry, not easiest because it has its hoops to jump through, but the lowest criteria of qualified loans that you're going to do. Let me make sure I say all of that properly because there's some moving parts. Thank y'all for liking the video, subscribing. Make sure if you leave a super thanks if you're getting value as well. You can support the channel directly and leave a super thanks. If you go to the restaurant and leave a tip for good service, feel free to leave a tip here for getting good quality information that can change your life financially if you use it. So thank y'all for supporting. So FHA, lower criteria. It's going to be one of the lowest credit score criterias, flexible debt to income ratios, or, like highest threshold that it'll take on, as well as, debt to income ratios, all of that different stuff. So every major barrier that we talked about, FHA tries to address within the guidelines of the government. Why is qualified versus non-qualified really important when we talk about government and non-government? Government is going to do a lot of ability to repay, meaning that you have to come in with reasonable credit, reasonable income, stable income, and a decent DTI, debt to income ratio. They are going to try to do things in a way for minimum default risk. They are looking to try to get the best quality borrowers possible and open a door for those who are at those different thresholds and doing all right or okay or kind of struggling, but right there on the cusp. They're trying to design programs where they minimize the risk of 2008 repeating, where there was little to no standards and criteria for mortgages, and everybody collapsed at almost one time, and it nearly took down the entire financial system. That's how bad 2008 was. So ever since then, qualified mortgages and ability to repay, Dodd-Frank, all of these different loan programs and parameters and criteria came into play to make sure people can actually afford homes. Not to the point where nobody can afford them, because we need people to buy homes and live in them for the economy to work. But it needs to be stable enough where everybody and their mama's not going to default on it, okay? That's qualified mortgages. So FHA is at the most flexible in that bucket. Thank y'all for liking and supporting the video. Leave a super thanks, leave a like, subscribe. I'll drop constant content informing you on this type of level all day long, okay? So FHA is going to be the most flexible around it, all right? It is doing its best to try to reach those of us that don't have the perfect financials, but are right on the cusp of being stable and could possibly be good homeowners, okay? And good stewards of the loan that we qualify for. That's FHA. Conventional is going to be a little less flexible and the most common loan type at most banks and lenders. Conventional basically means it's still Fannie and Freddie, so government criteria and guidelines, but not quite FHA, where the government is literally backing a loan, right, and behind it and setting the criteria and the rules. Banks have a lot more flexibility to kind of set their own terms with conventional. Down payment requirements can fluctuate. You will see some really unique programs where it's 0 down or 3% down, but commonly conventional loans are going to be 5, 10, 20+% down loan options. They're going to have a little bit stricter credit criteria. So FHA can potentially go down to 500, but it's more commonly going to be seen to be around 580 to 620. Conventional 620 is a much more common floor. That's like the lowest conventional will go in most cases. And then it's higher up. Down payment requirements, usually 5, 10% and up. You will see 3%, you'll see 0% sometimes. But generally speaking, you're looking at a scenario conventional is going to be 5% and up, 620 and up. So that having been said, DTI requirements on conventional usually tighter. You will see sometimes it's up to 50% or kind of like where it's almost like FHA standards, but that means debt to income ratio. Just for clarity, to make sure y'all are keeping up with this, the higher that percentage is, the more debt you can have at one time and qualify for a home still, okay? Regular conventional and, even we'll get to USDA in a minute, they have that like 30 to 40% type numbers for DTI. So it gets kind of tight because if you got student loans, like my individual on here that was saying they got $1,000 a month in just student loans. If you have $5,000 in income a month, that's 20% going out to student loans out the window. You see what I'm saying? So now when you start trying to squeeze a mortgage in and you only got a total of 30-some or 40-some% in debt you can have, hell, if you got a car note for $400 or $500, you got a student loan for $1,000 a month, that's wiping out how much home you can afford. You see what I'm saying? That's how it squeezes you out of qualifying for a home. So it's very important to look for loan opportunities that will fit your DTI criteria, okay? So conventional is, you have to be mindful of the lender because conventional can be tight around that sometimes. USDA is another one. VA is another one. VA is going to be another great, flexible, is only generally for veterans and military folks, okay? So I'm not going to spend a ton of time on that because I don't know how many of you guys fall in that criteria, but VA loans are arguably the best loan for the most flexible criteria, lowest documentation requirements, lowest barrier to entry. And rightfully so. Shout out to all the veterans and military affiliated people out there that qualify for home loans. Shout out to y'all. A lot of y'all have done y'all big one if you've been, veterans, or if you're actively in the military and willing to put your life and quality of life on the line and separate from your family to try to stand up for what our quality of life in this country. Shout out to y'all. So VA is the most flexible, but if you're not in that bucket of military, then we're not going to spend a ton of time on that. USDA, that's going to be what's called designed for rural development, okay? So that is a loan that is designed for non-metro area, immediate metro areas. So it's not inner city, it's not immediate outskirts suburbia. It's a little further out than that, but it's still a pretty broad range of the country, believe it or not. You ever look at a map for USDA? It is like 85% of the country still. It's just those big concentrated urban areas it doesn't count. So USDA is going to be a loan program designed for outskirts suburbia and beyond, but it is zero down potentially. The DTI requirements are kind of tight, but the credit requirements generally are like 620. But it is zero down. It allows you to get in and you can, get yourself a nice suburban home on the outskirts, maybe even get some land and get all of that accomplished under USDA, with zero down. So it's very, very good. So that's the qualified mortgage side. The other side of this equation, and why, again, at the title and the helmet of the video, I kind of talked about credit scores being an excuse. For one, as you can see on the qualified mortgage side, you can still get in at moderately low credit scores, potentially 500 if you find really unique lenders and you have a lot of money down. But think 580 to 620, you can get in the door. On the other end, for our non-qualified loans, this is the more unique side. This is where you get away from your strict ability to repay. It still kind of applies, but you can kind of get away from it. And this is going to focus on a type of lending where they're looking at your strong suits to help get you in on a mortgage, okay? So the example I gave about being very, very cognizant of your income, having it for 2 years, being able to prove it, document it properly. Non-QM, non-qualified mortgages solves for this kind of stuff, okay? They're going to say stuff like, okay, well, you don't have a clean W-2 income, you're 1099, you're a gig worker, you're a freelancer, you're an independent contractor. Cool. We're not going to go off the W-2s. We might even skip out on tax returns, but we need bank statements. You can literally get flat out straight bank statement loans, okay? What that basically means is from the income side of the spectrum, You can literally just provide 12 months, 6 to 12 months of bank statements, or maybe 2 years of bank statements, and show your inflows and get credit for that as income and qualify for a mortgage. You will have slightly higher interest rates than normal. You will have a slightly higher down payment requirement than normal. But again, the goal is just to get on a property ladder, all right? So bank statement loans are a thing. You can do asset-based loans sometimes, or a scenario where you just might have, really good cash. You might have, really large stock portfolios, or just some unique scenario where you have assets that banks might be willing to work with you on. You might still need to have, reasonable credit. You might need to have a decent down payment, but they're going to go up. They'll say either you got high income or you have a really large down payment. We can do bank statement loans. We can, if you get a multifamily property, you might be able to qualify for some of the rental income or the potential rental income of the property. Okay. So give me 1 second, because I want to get a little bit more specific. Because I was drawing a blank, but there's a ton of loan products that I want to just name out. Here we go. So these are just a few, and these lean towards investors. So let me back up. Homes for home owners. Yeah. So non-QM options will include stuff like bank statement loans, asset depletion loans. So this is for high net worth individuals. So that's kind of what I was alluding to a second ago when I talked about having a lot of assets. 1099 loans, so self-employed. DSCR, this is more for investors. Interest-only loans, so that gives you an opportunity to not have to pay principal and interest. Foreign national loans, non-prime loans, so geared towards borrowers with a history of credit challenges like bankruptcies. Short sales, foreclosures. These loans offer flexible credit requirements compared to traditional loans. So lenders may accept scores as low as 520. So that's called a non-prime loan. ITIN loans. So if you're somebody relatively new in the country, or you have people, that are really want to get into home ownership, but they don't have a social yet. They don't have full citizenship. There's ITIN loans that exist. P&L loans, a solution for business owners. So you don't have a clean income, you're a business owner, you don't have clean W-2s, clean tax returns, this can go off your profit and loss statements. So this is a common financial document that business owners tend to file their income through, and their business revenue through, and what they're paying themselves. Written verification of employment loans. Some lenders may qualify borrowers using only a written verification of employment, provided flexibility for unique employment situations. So if you don't have an official big-time employer that can easily verify income with, or you can pay stubs with, you might work for some really small company or business. There are lenders out there that will take verified written letters of verification of employment. So, these loans are going to have higher interest rates. They're going to have higher down payment requirements. But these are small examples of many others that are out there where lenders are the non-government side, the private market, has performed and provided several loan options that exist for you to get on a property ladder. If your credit's not the best, your income is hard to prove or isn't stable in certain ways, if you, maybe have assets or you have unique employment situations, you got some of the strong suit, like, again, assets or income or cash or stock portfolio or whatever. You have other financial tools. You might be a certain profession. There's loans for teachers. There's loans around doctors. So you're in a certain profession, your finances aren't the best, but you have a certain profession. There's mortgage loans around you just being a teacher, just being a doctor, just being a police officer, a firefighter. There are a lot of different loan options that are available out there for you that you don't have to fit the perfect criteria or box to qualify for, okay? So a credit score is just an excuse, generally speaking, a valid one to an extent, but it is an excuse as to close you off and give you this impression: if I don't have a really decent credit score, I can't qualify for a mortgage. It's not true. And that was the whole premise of all of this that I went through for an hour 15, and particularly getting to this back end where I show you the difference between, the mainstream loans that you see advertised and talked about versus the ones on the back end that you don't even know exist. A lot of you don't know exist that can help you get on a property ladder and start building real legacy wealth today and creating an asset portfolio or financial stability or control today. So there's a whole other world of loans out there if you have other financial strong suits. So before I break off and read additional comments and wrap this up, comment down below if you'd like me to elaborate and maybe focus strictly on the various different loan products that I'm going to do that anyway, but I'm going to do it a lot slower than I might do it if you guys are looking for a really strict breakdown and maybe an entire live stream where I just strictly go over the products and strictly go over the criteria. I can do that for you, but I plan on breaking it down product by product, video by video is my goal. But if you guys want to like comprehensive, where I like stop skimming over and actually go through this in depth, let me know in the comment section down below whether you're still on the live stream or you're watching the replay and you've gotten this far into the replay. Comment down below and let me know if you'd like me to just like do a comprehensive. But for now, I'm going to probably go product by product, video by video on this. But I want to give a more comprehensive breakdown because I want to encourage home ownership. It is so important for you to understand the value of home ownership. It is still very much an important financial pillar, financial potential asset or tool at least for you on your journey to building wealth and financial stability and success and control for yourself. Owning a home is still pivotal. Like there's so many, renting is fine if that fits for you, but there's a lot of things a lot of financial benefits and a lot of lack of control around renting. Home ownership is still a smart financial decision, period. Make sure you buy strategically, look for distressed properties, buy distressed properties, buy multifamily properties or properties with additional dwelling units that you can customize into some kind of rental income or rental potential. Buy properties that have the ability to be configured a certain way and buy properties that have the ability when you move out that can be your first or next rental property. Buy strategically. Buy strategically. All right. I appreciate you for sticking in this long, Truer Than You Know. You're doing a good job. You're doing yourself a service. Do you hear about good outcomes when people try to minimize their mortgage loan amount by asking friends and family for money at 0 or nearly 0% interest? I hope I'm understanding what you're asking. Are you basically saying people are borrowing or getting gifts from friends and family to buy their home? Is that what you're asking, Truer Than You Know? Are you basically asking like, hey, you're going to friends and family and getting them to gift the money or borrow the money from them? Can you clarify that before I try to answer that question? Anybody else that happens to be on a live stream that wants to like pop in, let me know they're there. I have any questions, let me know. Again, I encourage y'all to like, comment, subscribe, leave your super thanks to support the channel. Say yes. Is it yes to gifting or yes to borrowing? I just want to make sure I'm understanding, Truer Than You Know. Leave your super thanks. Leave support to the channel. Literally, I'm going to flat out declare and say it. You're getting quality information, dedicated, extensive. I'm sitting here as if I didn't work all day, an hour plus on this live stream, providing this information, and you're getting it for free. Feel free to support. I've worked hard. The channel is at a point where you can actually directly financially support. Asking families for gifts to help get started. Man, absolutely, Truer Than You Know. Listen, if you are getting gift money from family and friends, that is literally what other groups of people, and I don't know your background, ethnicity, race, whatever. I don't know. You don't have to tell me. But that is what the people, the ethnic groups and racial groups that are at the higher end of the home ownership ladder, like more commonly owned homes, many of them are benefiting from gifting from family. Like there's whole cultures where like the Jewish community, they're very notorious for gifting money and gifting towards buying a home and like passing down money and gifting towards these things, and that like perpetuating into stuff like home ownership. So if you're saying from a gifting perspective and not like borrowing the money from family and stuff, yes, that can have a great impact. Because again, you have to think the more money I put into the transaction, that's immediate equity in the property. So that's immediate net worth value right out of the gate. If it's gifted and you don't own it back, that's immediately allowing you to get equity. But backing up a little bit, that's more home you can afford. If you get gifted, let's say it's a $300,000 property again, because median home prices are more closer to the fours. So 300 is a little bit more to the, entry level nowadays. But if you got a $300,000 house you're trying to take down, maybe you save 5% of that, down. So maybe you got, like, let's say $15,000, right? But if you can turn around and get a family member to give you another $15,000, or family to come together and give you another $15,000, you just were able to put $10,000 down on that home. Or even more creative, if you want to get an idea of how this can add value, because you were trying to figure out what are the benefits. For one, equity. Two, qualifying for the home. Three, if I don't use it for my down payment, and it's not necessary, I can buy my rate down. How does that impact the mortgage? I'm paying less in interest. That's saving me a ton of money. I can take that gift money and use it towards buying down my rate. A process where you put it cash towards, the mortgage rate was 7%, but I did a buy down. I threw some money at it and they allowed me to buy it down to 6.5 or 6.25. If you stay in that home for 5, 10 years or 15 years, you're saving thousands of dollars down the line on the life of that loan, because you bought the rate down and you used maybe a couple to a few $1,000s of gifted money. So you can buy your mortgage rate down. You can use it for closing costs. You can just all kind of ways that within that transaction. The more money and cash you have, the better you can benefit in that transaction. Down payment, buy my rate down, closing costs, just the various forms of credits. You can do a lot of interesting things, prepay different things. Like you can make some things shake when you have gift money coming in, truer than you know. So yes, if you can get that benefit, that gift, absolutely tap into that. All right, absolutely tap into that. If you can do it without it being a problem for you, okay. Financially speaking, it is a great move. Any last questions before I wrap this up? This one ran a little long, but I had to get it out. I still tried to rush through a lot of this, but I wanted to get a lot of this out and at least lay down the framework and the foundation to getting around some of those common barriers. All right. Before we leave, I missed an entire category, and I'm not going to back up too much and go into it in depth like I wanted to. But down payment assistance programs. Down payment assistance programs. Before I leave, I got to touch on this. I almost forgot an entire portion. I'm trying to cover so much information. Down payment assistance programs are abundant. And the reason that they are abundant, asking family for a gift to help you start. Anyway, the reason that they are abundant is because the economic system needs us to buy homes. So the government needs us to own homes because that economic activity generates tax revenue. So blighted and empty properties is not a good thing for local, city, state, or federal governments. That is unproductive property, not generating tax revenue. It's also not involved in stimulating the economy. Private sector wants it because homes generate economic activity. There's jobs around all these different components of keeping, people owning the home and keeping the homes operational. So there's, everybody from the landscaper, the plumber, the electrician. If it's a rental property, there's property managers. There's all kind of, the insurance companies that are insuring the property. There's just all kind of components in every single property. So homes not being occupied or there not being enough people in homes is not a good thing for the economy in hardly any way. So there's always incentive. So what are the various places where you can find down payment assistance? Government agencies, federal, state, city, local. There will be something available across the board for government, from the government for down payment assistance. There you have to do your due diligence. And this is where working with really good real estate and financial professionals are important, because they'll usually be privy to these things. Because obviously there's incentive to help you qualify for the mortgage. Thank y'all for y'all likes. To qualify for the mortgage, right? If I'm a loan officer, if I'm a realtor, if I'm an appraiser, whatever, whoever it is, we all need you to close on this property and to get in on it, because we get paid as the transaction goes along and closes, okay? So we are privy to programs out there to help you get more cash into the deal and increase your chances of closing. We're incentivized to do that. So state, local, federal, there will be something there. I almost assure you, wherever you are, there's incentive to get you in the homes and to get homes occupied and owned, okay? Especially for homeowners, not as much for investors because that's a different situation, but homeowners, absolutely. So make sure to nowadays, a lot of different websites like the Zillows and the Redfins basically will do that due diligence and research for you and let you know by the property, rather. Like, if you're looking at a certain property, they'll tell you what that property might qualify for. And they'll ask you some questions. Are you a firefighter or a police officer? Are you military? Are you this group? Are you that group? Are you from this background? Are you first-time home buyer? They're going to ask you all these different questions to control and to search for and weed out and, what programs you can qualify for. Okay, so it's getting a lot more common to find out about these things, but you still want to do your due diligence. So the local, state, federal government, this is very common for down payment assistance. A lot of you missed this one. Next one, nonprofit organizations. There are a lot of them out there. Many nonprofit organizations nationwide offer a variety of various forms of down payment assistance. These include grants, low interest loans, deferred payment loans. Examples, they give examples to like in Colorado has one, etc. Okay, but we ain't gonna get into the weeds on that. Nonprofits exist that can help you get, there's nonprofits out there that exist that lenders are partner with that you can do 0% down on duplexes. There's the same thing for conventional loans sometimes of nonprofits behind that'll contribute. Sometimes they contribute so much money in grant money, or they'll give you a low interest rate loan that can be used as a down payment towards a property. There's a lot of different unique nonprofit opportunities out there. A lot of y'all miss that and don't know it. Lenders, a lot of banks and lenders that are right under y'all noses, especially some of these smaller institutions that y'all don't even know exist, I never walk into or pay attention to, have a lot of impressive grant programs or interest rates, grant programs or closing cost assistance, or just overall down payment assistance programs. There's a lot from banks. There's money that they're directly injecting because obviously if you qualify for the loan, they're just putting money towards getting you qualified for the loan so they can make their money later on the loan. So they want loans out there. That's where they make money. So if they can help, if your problem is like, which is most people's problem, I have okay income, my credit is reasonable, I got decent qualifications, I don't have cash. A lot of people have a hard time saving down payment and closing cost money. So the biggest incentives out there are around down payment and closing costs. Banks have a ton of this. And they can be combined. That's the next thing. Nonprofit, state, local, federal, and lender-based down payment and closing cost assistance programs can be overlapped and combined. Look for these things, ask about them, connect with professionals, do your due diligence, and do the work. You can possibly close on a home with little to no money in it. Not because the requirement wasn't there, but because between the bank, between the nonprofit program, between the state and local program, they all poured into this bucket and covered the down payment, covered the closing costs. Hell, they even threw in the seller threw some credits in, and you're able to buy your rate down. This kind of stuff happens. So you can get on the property ladder, getting to the benefits of homeownership and the legacy, the financial legacy and retirement benefits of homeownership, and do that without even putting much of your own money into the deal. Again, getting you to homeownership faster, because how many years might it take you to save 10 or 15% down, or 5% for the down payment and 3% in closing costs? All of these different things. If you can knock off that criteria and that challenge by combining all of these different programs that exist out here, down payment assistance, closing cost assistance from your bank lender, nonprofit program that may be in your area that you qualify for, using your profession if you're in a unique profession that has a lot of support around this, and state and local governments that are putting a ton of money towards homeowners, either first-time home buyers or not first-time home buyers. You can literally cut your time down by years trying to save your way to this by combining these programs together and improving your affordability, because the more cash you can bring to the table, the more home you can afford. So I almost forgot completely about down payment assistance programs. If you happen to have rode this live stream all the way out to this point, you are an absolute trooper, and you need to pat yourself on the back for giving a damn about this enough to stick through an hour and a half long live stream. Crucial quality information. So it's not that it wasn't worth it, but I know a lot of people just don't have the bandwidth for this. So shout out to you for sticking this out. For all of you that tuned in live, and definitely if you caught the replay and watched this all the way out through the entirety of this live stream. One was a rural area program. The other was a first-time homebuyer program. Yeah, I know I have two friends that took advantage of two separate programs. Yeah, for sure. Listen, they'll have a program on top of a program with side of program sprinkled with program on it. I promise you, you will not have a hard time finding lenders, nonprofits, and government agencies or entities that have money on the table for homeowners. There's so much economic activity around homes. Trust me, it's out there. If you can get yourself to that barrier where your credit is reasonable, your income is situated, the cash part is one of the places you will get the most help. You can't do a lot about DTI. You're not going to have a ton of flexibility all the time on the income part, the credit part, all of that. Like I told you, there's different programs out there. But, reserve requirements, that's a big one. But cash, like cash to close, down payment and closing costs, there will be something out there almost certainly. First-time homeowner or not, I promise you, between profession, between just the local government trying to incentivize something, a nonprofit trying to do their good work in the community and get grant money and whatever, and lenders trying to, increase their home lending activity, I promise you'll find programs out there. I guarantee it. All right, I need to wrap this up. This is getting long. Again, shout out to every single one of you who invested in yourself to watch this entire live stream. I know I dug into a lot. I also skimmed over a lot. Comment down below and let me know if you have anything you want a more extensive breakdown on. If you are in the process of considering buying a home or, just want counseling around this, comment down below and we can look into an opportunity to work one-to-one. Comment down below on any questions that you have. To all my pioneers, welcome back. To my new viewers, welcome in. My new subscribers, welcome in. I want each and every one of you to stay focused, stay in motion. I'll see y'all soon.